At 95 years old, Warren Buffett is famous for sticking to low-cost, asset-light businesses. Yet he just broke his own mold, making Alphabet, the parent company of Google, one of Berkshire Hathaway's largest investments. For decades, Google was the perfect asset-light software company. But today, they are undergoing a massive, very physical transition. This chart shows Alphabet's capital expenditures. After years of flatlining, spending suddenly spikes, doubling to $35 billion in a quarter. Management officially guided toward $200 billion in total expenditures, earmarked for building physical AI data centers. Why is the strictest value investor buying Google during its most expensive, asset-heavy period in history? If we go back to the early 2000s, Google solved internet monetization by inventing pay-per-click sponsored search advertising. Buffett saw this firsthand. One of Berkshire's largest subsidiaries, Geico, was heavily dependent on this ad base, paying $10 or $11 every time a user clicked a link for auto insurance. This equation illustrates the core mechanics. $10 revenue minus zero production costs leaves a nearly absolute gross margin. This compounded over 2 decades, generating tens of billions in free cash flow annually, ultimately building a debt-free balance sheet holding $142 billion in cash. Having a digital cash engine of that magnitude creates an unmatched financial war chest, giving a company the sheer capital needed to survive whatever technological shift comes next. The current pivot to massive AI server buildouts is an absolute defensive necessity to protect that core search monopoly. Legacy tech giants of the past stubbornly refused to adapt when the hardware game changed, and they quickly lost their dominance as a result. The focus for value investors shifts from the raw dollar amount spent to the return on invested capital. Buffett isn't blindly trusting large language models. He is looking closely at Alphabet's proven track record of maintaining a 20 to 30% return on equity. Alphabet's management has consistently operated as elite capital allocators, placing huge, successful bets on YouTube, Google Cloud, Anthropic, and SpaceX. Extreme capital expenditure is dangerous for poor management teams. For elite capital allocators, it becomes a hyper-growth compounding machine. We also have to look at Buffett's immediate dilemma. Berkshire Hathaway is sitting on a mountain of cash and needs a logical place to deploy it. His safest alternative is to park those billions in risk-free U.S. Treasury bonds, taking a modest, guaranteed annual return. This visual scale compares those low-yield bonds against Alphabet's valuation, which is currently trading at a highly reasonable forward P/E ratio of 14.3, and the underlying business backs up that valuation, having grown its earnings per share tenfold over the last 10 years. Modern value investing isn't always about hunting for a cheap stock. Often, it's about buying a compounding cash engine at a fair price. The companies best positioned to win the AI race are the ones with established cash cows already capable of funding the massive required infrastructure. Trying to precisely time an unpredictable tech cycle is extremely difficult. Finding proven capital allocators and letting them put your money to work is a much stronger long-term bet.